And joining me right now on the podcast, and of course, catch us in video live right here. And Paul's looking smart as ever. I've made a bit of an effort with the shirt, but who knows what's going on down below. It's a bit like the markets. You know, you can see what's happening on top of the markets, but what's the worry below, the undercurrent that people are worried about? Fella, how's things anyway?
Yeah, I mean, actually on the markets, etc., we've had some pretty monumental sort of like macro news. It does seem as though, calling Houston, we've got an inflation problem both sides of the Atlantic. I mean, the UK, it means that interest rates are going to go up more than previous expectations. So we look as though we're going to go from around about 4.5%. Currently, the Bank of England is going to lift that by another quarter percentage point next week, and then probably top out at around about 5.5%. And then we had some huge news really overnight. And we had a relatively sort of in-line inflation report print coming out on Tuesday from the US. But what's been stood out to me for the last couple of months, and I've been sort of banging the table here, is that really we've got entrenched wage inflation, and that's really been worrying the Bank of England and the Federal Reserve. And nobody was expecting what Jerome Powell was going to say yesterday. I mean, he came out with a real hawkish hold or a hawkish pause, and the dot plot, which is the Federal Reserve Board members' predictions of what their economic conditions are going to be, is suggesting there's going to be 2 more rate hikes on top of the existing listing level, which is just over 5%. So it's going to go to around about 5.5% by year end, on the basis that the economy is hotter than they'd previously expected, and then will probably stay higher as well going forward. So it all comes down to this whole inflation sort of like conundrum comes down to what a wage is going to do, and has it gotten entrenched. And one's obviously problem from the pandemic was that the participation rate went down because people dropped out of the workforce, and then we got a reopening, and it's meant that essentially a lot of companies struggle to actually hire, pushing up rates. And now they're in this stage whereby they got rid of everybody at the start of the pandemic, and they're a bit cautious about getting rid of everybody again. They want their own labor hoarding. And therefore, it's great for the economy. It keeps puts money into people's pockets. But really, 3.5% in the States unemployment is too low, probably. I know it's a horrible thing to say. And probably 3.7% is too low in the UK to have stable wage inflation of roughly around about 2 or 3%. Not on both sides of the Atlantic, it's still over 5%. And there's no signs of it imminently coming down, given that there's still plenty of job vacancies. And just look at the number of strikes. I mean, this side in the UK, we've got and out in France and stuff. So yeah, we've basically got interest rates going up on both sides of the Atlantic, and I suspect the ECB today will also hike interest rates, largely on the back. And what that means, this is the thing, is what it means is that the cost of capital for companies is going to go up when they roll over their debt. And so that's going to hit more on the small and the mid cap. So we've just got to be careful, as we've said many a time, when you look at buying companies, have they got strong balance sheets, and have they got recurring revenue streams to be able to get them through a sort of like a tougher period and roll over that debt? Because if they haven't, then it's going to be really painful.
Yeah. Do you know what? I was really surprised. I normally put alerts on, but I looked at the 2-year yield, a UK government yield, and if we go back with the deadly duo, Truss and Kwarteng, and in September,
Man and Robin,
in September, 27th of December last year, it got up, it peaked up very quickly, went up to 4.7 2-year yield. And now it's just gone above that. It's now at 4.84. And you're thinking, wow, it's a gradual rise. So it's normally the acceleration that scares people, but that says a lot, doesn't it? Now, what was the reason? I did watch a bit of, with my wife talking in the background, I did watch a bit of Jerome Powell last night, but what was the reason for the pause? If they're going to continue to raise rates, and I did see Jeffrey Gunlock of Double Line Capital saying they're not going to do it. They're not going to go any further. That's it. He thinks that's done. And I think that, what was the point of pausing there? What was the reasoning behind that?
Well, basically, they have this blackout period where none of the actual Federal Reserve members can talk 2 weeks before a rate rise. So none of them have actually been talking to the press. But the week before, there's about 10 of them who all did. And the majority view came out that they were going to pause. And that's what they signaled to the market only sort of like, 20 days ago, 15, 20 days ago. And on that basis, it sort of kept their hands tied that they were going to pause rather than actually hike. And that's the reason why, in my view. Yeah, I mean, I just think it's because they'd indicated so much immediately before that blackout period that really it would have been a bit stupid to hike, having said and indicated only 15 days ago that they were going to pause. What then the come then is what did that inflation print really change it? And it didn't. But what did, and you could say it did, was the hikes in Canada and Australia and the higher sticky inflation we have obviously in the UK, plus the strong and consistently strong wage growth in the US. And I think that's what sort of tipped the balance, that they were going to go for a real hawkish pause, i.e. such that until wages and salaries start moderating, then we're going to basically nail it going forward. And I think that's what changed their mind in between.
Do you know what? Part of me is like, maybe we'll scrape through with it. Maybe we're in recession a little bit, if we get revised figures and all that stuff, and we'll say, oh, we were in recession. That's why it explains why the market's been like it is for a while. But part of me thinks when you look at certain indicators, like the yield curve, again, now it's gone back to almost 1% or 0.9%.
Yeah, it's terrible, isn't it?
It's crazy. It's never been, like I said, in fact, it's never been that bad in 40 years. Now, to point out what, for people, the inversion of the yield curve, that has predicted the last 10 recessions, since 1955. That's a very accurate indicator, and it's the worst inversion it's ever had in this time. So I'm just thinking there's something wrong here, and part of me thinks there's something wrong. That's why I've got, I'm cautious. That's why I've got cash and stuff. And I just think it is true that the Fed pretty much are driving using the rear view mirror, and you're going to crash, and they're going to crash the economy. Like I said, they've been lagging behind everything. We don't know the effects of this. Like I said, we've already been at these heightened interest rates for a while now, and we don't see the lag effect. And I do think, that I sort of agree. I don't think they'll rise anymore. I think they'll start seeing deteriorating economy, metrics coming out. There is, in fact, we realize then. And then it's almost like turning around a big tanker. You've gone too far. You've got to start braking a mile before, you see the coastline. You can't start braking 10 yards before, put it in reverse quickly, because then all hell will break loose. Part of me is in that camp, thinking, something's gone wrong. They've gone too far. And something, I don't know what it is, but deflation, I don't know what's happening. It'll take long to wind us back. But part of me is very cautious and very worried. That's why I hold, about almost 0.5% cash.
Well, let's be clear about it. Higher interest rates are good for savers like you. You've basically got higher cash. You get more on your interest. You're now getting sort of 4. If you put it wisely, you're getting 4 or 5 or 6, maybe even 6% on your cash in a sort of like an FCA supported bank. So it's not, it's pretty good. I would say I wouldn't criticize them by looking in the rear view mirror. I'd actually say what they're doing is actually looking forward and saying, okay, we all accept, particularly in the States, inflation is coming down, and we see that through the stats. That's the rear view mirror, etc. But push the clock forward 6 months. At the end of the year, where are we going to be? And the problem that they have is such that if we haven't nailed wage inflation, which is such a big chunk of the corporate cost base and the economy, if we haven't hit that one over the head and knocked it down to really less than 4%, which is no sign of it doing so at the moment, unless we have done that, then we're going to get to a stage where inflation's going back up. So it will come down, maybe even hit 2%, maybe below 2% in the short term. But by the time it gets to the year end next year, it's going up again, unless we've really sort of lanced that boil. And that's the problem that the UK, the Bank of England, the Federal Reserve and the ECB are struggling with. How sustainable is the decline in inflation? And that's what people are missing. They think, it's down, we've solved the problem. Well, frankly, it isn't, because the biggest driver is wage inflation. And unless that's gone, then it doesn't matter. Your offsetting of goods inflation is only a matter of time.
Yeah, but just look at commodities, for example. So they're on the floor pretty much. They've been bumping on the floor. I mean,
oil's about $70, isn't it?
Yeah, and it was coming down from 125, and even though like I said, the Saudis and all that are trying to say we're we're going to reduce production, it has a little blip, hardly anything, it goes back down a little bit. And so that's a little bit worrying, just commodity prices. And I think what's going to stop wage inflation in the end, what they have to do, like I said, they're not going to admit to it. What they have to do is slow down the economy.
Well, that's what they do. It's a blunt tool.
Yeah, exactly. Job losses will happen. And so I think, but again, very blunt, how can they predict how bad that's going to get, the slowing down of the economy? And I don't know if they do. And so they've
no. Okay, right. They just haven't talked about it, right? Just the mechanics. Yeah, you stick your foot down on interest rates. Okay, it shoots up, right? You've got a participation rate which is relatively low because of obviously long COVID and stuff. You've got corporates hoarding it, yeah. So you keep your foot down on unfortunately the interest rates pedal until because you're playing chicken with the corporates until the corporates basically said, right, okay, I can't afford to hoard labor, to carry too many people, and then start shedding. That's the problem. So when you come back to your question, how long is it going to take? It's really you're playing chicken with corporates to decide how long are they going to labor hoard. And you've seen it in the tech, they've started to shed, but it hasn't lock, stock and barrel started elsewhere. I mean, you've seen it in places. There are a number of old economy stocks are shedding it. The problem is that it's going to take longer in Europe and in the UK than it is in the States, where the labour force flexibility is much easier. So,
but how long does it take? That lag factor, like I said, how long does it take before they start, say, for example, holding labour, getting rid of labour, laying off people, and then seeing prices come down sustainably? How long does that take? What I'm worried about is the lag
6
factor.
to 12 months.
Yeah, exactly. The deteriorating economy for 6 to 12 months before they even adjust interest rates. So that holding higher for longer, how much effect, deterioration will it have on the real economy?
Yes.
Before people say, "Oh, hang on a sec." So so that's the thing. But in fact, to my predictions. Your prediction was spot on. When we talked about Polarean last time, remember that on the Thursday?
I have to apologize. That was pure fluke. Okay,
I know. It was. I mean,
I had no inside track. I can promise you.
I was going to say, some people may think we have inside track here, but we were talking about what's happened with Polarean, and we, said pretty much we know it's world-beating tech because they've had over 100 peer-reviewed papers on their technology, and we're talking about institutions like Cambridge University, Cincinnati sort of Children's Care, sort of really key opinion leaders using their technology, publishing papers. And yet they hadn't signed any sort of major deals here. And I said, I said, you've got one or two sort of companies, hospitals signing up. And you said, you said to reiterate, what they need is a big MRI manufacturer to come on board. I said, yeah, that's the way to roll out, very quickly. And then the day after, it came out with collaboration with Philips to be featured. Yeah. So Philips is one of the top three. You've got GE, Siemens, Philips, and these MRI manufacturers. And now they are going to install Polarean's technology in that. And that's, to me, that's excellent. It's not exclusive, which means GE and Siemens will. I'm just thinking, if you are GE or Siemens and you haven't got the best tech in your machines, then there's going to be less hospitals using them. So going forward, I think there's scope for these other big manufacturers to incorporate that in there. But that's very good news. A good starter, that
Well, I haven't got any other predictions like that.
Hopefully, what's the lottery numbers?
No. Other than that, actually, for there's two companies I just want to give you an update on news, and I know one you used to own, or we may still own, I'm not sure, but it's Verici DX, and they came out with prelims or audited results, last week, all in line, etc. But they've got they've got pivotal study results coming out for their second sort of like lead test, the Clarava prognostic, which allows doctors and patients to better sort of like predict whether how a patient's going to react to a donor kidney transplant when it's put in, and then to adjust the actual treatment. So it's going to be really, really useful. There's no comparable test. There's nothing out there that doctors are currently using. So if it comes through its pivotal validation study, with the results out imminently by the end of June, then this will be a real feather in its cap. And just to give an indication, the first one, Tutivia, which is a diagnostic eye post-operative test, and it passed that validation study with flying colours. Now, what this means to me, and this is where I come back to sort of Polarean, etc. Once if that comes through, and I've got no reason to believe it won't come through with sort of flying colours, you've just basically created a platform of diagnostics, both pre and post transplant, that is pretty much unique. And so the technology as a platform works, so you can roll out further diagnostics like their Protesia one, which is a longer term kidney transplant graft diagnostic. But what it means then is that, you know, M&A, etc. One, it puts you in them in a good position in terms of, you know, developing and commercializing that suite and that platform of products, because it's pretty much unique, best in class. But equally, at this such ridiculously low valuation, hey, you know, if you're a big diagnostics company in this space, I don't know, somebody like CareDx or, you know, Exact Sciences or Roche Technologies or anybody with world-leading technology, I mean, you just must be salivating just thinking about that. You can pick this company, even if you pay 100% premium immediately. So when it comes to my second prediction, I'm not predicting that Verici is going to be taken over at all. But all I would say is that once you've got that validation of the technology, like Polarean did with its FDA approval, once you've got it, you open doors to the biggest players in the industry. And therefore, you have a seat at the table to decide about how you develop that business, whether it's organically, whether it's your own acquisitions, or alternatively, whether you are, you know, basically bought by a bigger player because you have a unique platform that has huge barriers to entry and marvelous IPR. So I don't want to get ahead of myself because we haven't had those second studies, but I'm hoping over the next 2 weeks to speak to the CEO, Sarah Barrington, who I've spoken to many times before, and I think she's first class, really, really good. I mean, so commercially astute as well as, you know, obviously on the medical side, and she's got a great team. And if that comes through, and even if it doesn't, Tutivia is great, and so there's not plenty of other shots on goal. But I think it will, given that the you know, the direction of travel for the platform is, you know, passing the validation study with flying colours.
Yeah, no, I like Verici. At the moment, I'm very skittish in the markets. I'm just saying we went to a point where, well, back in sort of March, a lot of companies just massively oversold and ridiculous. And in fact, Verici went down to what, 4.5 pence. It's
absolutely,
like,
and it was
and
90.
10 million it was 10 million market cap. And it's like
I know.
they had that in cash pretty much. And I thought
And
that's
it wasn't
silly.
90p.
Yeah, and I was thinking, I read the broker note on them, and they're saying that not only is they got best in class, they got first in class, and I thought that's in an area that's quite big. And I did take a position. It went up massively, but I did put a stop loss in. It tripped out sort of 12 pence. But there's a handful of stocks, right, in UK med tech that you can see they are like, you know, best in class, first in class, and all that. And that but at the moment, the market is not giving them any sort of validation or any valuation whatsoever. But they are, you know, it's worth keeping an eye on them. Verici is one of the things I would intend to get back in. Is just at the moment, I'm just worried where the market's going. It's like we have seen the start of a little rally again, I think, but along with, I think it's off the back of, you know, American markets, it's a bit crazy. But Nasdaq, for example, it's nuts. And what's worrying is, like, I mean, was it top 7 companies? In fact, you tweet that out from a top 7 companies, 50% of the S&P 500 valuation, which is a bit crazy and distorts the overall view. Nasdaq is about 15% of all-time highs. Is the economy that rosy? It's not. It's just nuts.
It is.
So
well, it's a crazy stat of the S&P 500. You know, you strip out the Magnificent Seven, who are up sort of on average 35%, but because they've got, if you add them all together, their weighting in the S&P 500 is about, I don't know, 40% or 45%. But when you strip that out, the rest of the 293 stocks are down year to date.
Yeah.
It's just
nuts.
So
what about does on Verici? How do you put, for example, a valuation on this? Because I looked at the market size, looked at how much they charge, all this stuff, and I'm none the wiser. I just thought at the time they had cash near their market cap, and considering they are first in class and best in class in a big area of unmet medical need, or, you know, they have no comparisons. But how do you value that, for example?
Well, I mean, it's difficult, isn't it, to a certain extent? But let's just put I've seen numbers of a total addressable market of well north of $500 million. Okay, in fact, $700 million or even more. Okay, if they just got, I don't know, 10% of 700 million, $70 million turnover, you know, this is a worldwide opportunity. Let's say in 5 years' time, that would be, as I say, 70 million a turnover. Gross margins on this thing would be 80%, you know, drop through. So they'd easily be picking up 30-40% EBIT margin. So, on that basis, they'd be doing what, 20 million of EBIT, give it a 10 times EBIT multiple, 200 million in 5 years time. What's the current cap?
It's 10 bagger, that is. Yeah.
Well, that's right. It's 20 million market cap,
Yeah.
and you discount back at, let's say, 12%, or let's say use 15%, which makes the maths easy. That'd be half, wouldn't it? So you get 100 million in today's terms compared to, net present value of 100 million compared to, 20 million now. So it obviously those are just hypothetical numbers, but you can absolutely see how there is. if you're a Roche or a, basically Care DX or another big diagnostics company, you just say, well, okay, I'll take that. I'll take that any day of the week. I mean, another one which falls into exactly the same bracket, which has world leading technology, who came out with some news, is Lunglife AI. Yeah, I mean, I underline the AI as well on it, and this basically does best in class or first in class lung cancer diagnostics, and it's going through its own pivotal validation study with the results probably in about 3 months' time, etc. Again, the shares have just been sold off. I can't remember what the market cap is, but I think it's below 20 million, etc. Big addressable market. They use circulating tumor cells. They did an initial pilot study to get before the validation study of about 150 patients. And that was basically just the result. The news was it just been peer reviewed by the medical industry. So they've been kicking the tires on this for over, I think it's over a year. So, this, and what they've come back is that it's demonstrated significant improvements in the accuracy and sensitivity of diagnosing cancer patients in terms of once they've been sort of screened for by a CT scanner, it's then deciding, is the cancer or is the tumor, is it benign or is it actually serious and they've got to remove it? And that's been the biggest problem for the industry. And this test allows physicians and patients using a simple blood draw to do, CTT testing, best in class sort of testing, etc., and come out with a positive result to say whether, yes, it is a cancerous tumor or whether it's a benign one, and therefore we can leave it rather than having to then do a biopsy. So, as I say, as a endorsement, you've had the best med heads in the world looking at this test for the last 18 months, 12 months, whatever it is. And they've said, yes, it absolutely stands up and it's best in class. Anyway, the main validation study results is coming out in about 3 months' time, and then they'll start the commercialization. And then they fall in exactly the same bracket as Verici, world-class technology, huge addressable market. And, basically they can either do it organically, they can do some M&A themselves, or they're going to be bought by somebody else, by a big, I mean, that really would fall into the Exact Sciences or even one of the big CROs who are looking to sort of expand into diagnostics as well, because plenty of consolidation. So yeah, I mean,
they had a big drop, didn't they, in the market recently? On the 9th of June, they just dropped. I saw that at one point it was like down 49%, and there's no news like that day. It's a huge, down 26%. So
it's a hugely illiquid stock, and somebody just dropped, I don't know, 20 or 30,000 shares, and it was absolutely nothing. So, I mean, all I would say is that price, when you get to micro caps, isn't a reflection of valuation at all.
Yeah.
Even when you get to large caps, a lot of the time it's not a reflection of value, and this isn't. It's just frankly nuts. I mean, they're both, Lunglife and Verici have both got sufficient cash to get them through into mid 2024, so at least another 12 months. What's that? I mean, the market cap's only 11 million, and I know this addressable market is over 1 billion lung cancer diagnostics. So
it's almost like it's a strategy, like we said before. You could take 1% in of your total portfolio in a handful of these stocks that have big total addressable markets, very big growing commercial end markets, have some validation from bigger players, and just sit and wait. And it's because you're not overexposed, you wouldn't worry too much. Then when you see one start really moving, then you can invest a bit more in it. So.
I mean, another one in that. Let's just go through some of the healthcare news, etc. I mean, another one was Avacta, and I've said before, they've got lots of shots on goal here. They've got their precision platform with the AVA 6000, which is going through your clinicals phase 1, phase 1A, and will be phase 1B. to get to that maximum tolerated dose and then the optimum dose and the efficacy data. So huge potential value upside there. They've got the Pharma platform that basically does diagnostics and testing, and then they've also been doing the acquisitions in the diagnostics, launched diagnostics last year, and then Coris BioConnect as well. Well, the news this week was that one of their joint ventures with Day One Pharmaceutics, they've basically reached a major milestone on the back of the Pharma technology, because they're using it to put into cell therapy and gene therapy technology, leading edge, etc. And they've met the targets that they actually required from, based on their on that science. So they've then been able to bump up they will do once the valuation's done, their shareholding within that joint venture. It just shows you that as an investor, what you can't see under the surface is so much bigger than what is actually the opportunity set. And it's that classic iceberg. It looks big on the upside, but actually it's enormous down under the water. And they've just got really a treasure trove of real world-class IPR. And the hard bit for obviously the management team is making sure that they optimize all of those opportunities simultaneously. And they've got an excellent front bench. I did actually go down to their capital markets day earlier in the year, and I was really impressed. You had great presentations from right across the actual the company. So it's trading at sort of a quid. As I say, it'll just stay around about that until, in my view, until they get that major news where the AVA 6000 has finished its phase 1A testing to find that maximum tolerated dose, then goes into phase 1B, where it's essentially getting some efficacy data, and hopefully by the end of it come out with a good idea about the optimum dosage level for patients. Once that happens, that will be a huge value inflection event, because we know at the moment that the Prodoxorubicin is safe. Unless we miss it, everybody's missing something. We know it's safe. It's much better than doxorubicin, the straight cancerous drug. And then it's all a matter of whether they do start seeing shrinkage of those tumors. So I'm hugely impressed. But it's we've said many a time, patience equals profits, doesn't it? As you're an investor, and you've just got to ride out the volatility, because it's extreme. I mean, super extreme in medtech.
Yeah. Well, do you know what? Looking at where the share price is right now, I mean, they are at £1, but they've bounced off this level many times, and it hasn't been below this level since April 2022, when it was rising above that level. But then it bounced back down a bit. It's bounced off this so many times, and it rose up to 180, 190, and come back down. So for it's a good risk reward here for traders. It's like it doesn't really go below this level. So you could put a stop just below that, because it doesn't really go below this level. It hasn't been for over a year. So we'll see.
Just to give you an indication, of a potential realizable value, right? Chemotherapy is massive industry, okay? And there's plenty of big pharma who need growth drivers in oncology. One of them, just down the road from where they are, is called, GSK. It's got its headquarters in Cambridge. Avacta headquarters, well, actually it's in London, but it's not far from Cambridge. And they used to have a diagnostics business in there in Cambridge. They've said themselves they're not going to be able to compete against the world leading immunotherapies that the likes of AstraZeneca and Roche and Merck have developed, or even the real sort of the niche cell therapies as well, the new ones, or the ADT, all those kind of real high end. They're going to go in somewhere else where they've got some strength. Would not make stupid logic if somebody like Glaxo or Novartis or somebody like that decides to say, well, okay, this looks like a nice asset to pick up, and I can then take it through phase 2 trials, because if it gets through phase 2 trials, phase 3 is then we've got all the historical data on doxorubicin, is almost a slam dunk. So phase 2 is the real killer, major, with a bit sort of like the major milestone to go into FDA. But hey, who knows? I mean, as I say, just on volatility, we got another one which has just been nuts, and we've been tracking it for 2 years, and I certainly like the technology, is portable oxygen concentrator, sort of innovator, Belluscura. and it's just about met all its commercial targets, and it's actually needed some more funding, and we've come just going full circle. It's been, it's struggled to get funding this year, but has actually just done so, completed it. It did a bond issue, convertible bond issue earlier in the year for roughly around about, I think it was $5.8 million, and then did an equity issue, a placing just recently, which the general meeting just approved for 3.1 million gross on sterling. So around about, I think it's, well, that gets to about $8 or so million, etc., just over. So they should have enough, and they've said in their trading that once that's gone through, they'll have enough cash to last them for at least for this year. They'll have about 3 million by the end of this year, and that the money they've just raised will help them develop and to commercialize their next major sort of product launch, which is Discover, which replaces their first lead product, and they can see that in 2024 and 2025 generating 50%, 70% of the total revenues, because it effectively, the big USP it has, it generates 3 times more oxygen by weight than the next leading, portable oxygen concentrator. And just to give people, understanding what these devices are used, they're used by patients to treat COPD, breathing difficulties and asthma and all this sort of stuff. And they're lightweight, portable, and they get people out of hospitals. Importantly, they just have a better quality of life, and it helps people like the obviously the NHS, and they've got some good good demand for it. So if you have to raise money, as we've said, the cost of capital is very high, and it's been expensive for them to do it. Anyway, they've done it. They've got over it. It's future-proof their balance sheet, so they can actually then commercialize the product. I'm hoping to catch up with the CEO, Bob Raucus, sometime over the next week or so, once the company now puts out its audited 2022 results and latest view in terms of commercializing that platform. But again, I think I'm not sure exactly.
Down at 27 pence there. It wasn't 130 like a year ago, pretty much. It's like,
the last target price that the house broker had was 120p, which is Dowgate, but that didn't, I don't think, incorporate the extra share count that they've now got, so they'd have to readjust that. But it's again world-class technology, and it's in med tech with huge barriers to entry. It's got FDA approval, it can now, once it's got its funding sorted out, it can now decide its own future, commercialize itself, potentially buy people if it needs to going forward, or alternatively, get bought by one of the big sort of like, device manufacturers, which would not be stupid either.
But you know what? It's time for my weekly mention of Destiny Pharma, because I did a video on the weekend, and I delved a bit more into the CEO change, and I can't see any particular reason why Neil stepped down. But looking at the new CEO, you think, hang on, people sell first in this market and then think about it later. So this doctor, you mentioned there, Novartis, Roche, GSK.
Yeah.
Dr. Deborah Barker's worked for high levels of all those, right? Now, I'm not down, putting it down on Neil, but Neil previously was an accountant from PwC. He stepped in last 2 PLC roles.
I'm an accountant. What's wrong with an accountant?
But he stepped in, last 2 roles was CFO roles. He's a numbers guy, which is a good thing. With small cap companies, you need a numbers guy. But his specialization wasn't in anti-infectives, So Dr. Deborah Barker stepped in. Now, if you look at his CEO, I said, worked at Novartis, like at 250 billion market cap. Roche, again, run at the same. GSK, about 60 billion. But she's also, at Novartis, she had several senior roles, including head of development of anti-infectives. Right? Now, what does Destiny Pharma do? Anti-infectives. That's spot on. She couldn't be more, suited to this role. And Neil beforehand was, even though he's very good with it, he took it, it's from IPO and did very well. So this is a more appropriate line. But even so, the share price sold off. I think it's crazy, really. And she says, my job now is to get in continued discussions on a partnership deal on their second lead asset, which is XF73. And like I said, this is wholly owned. It's twice the size market potential of the initial asset they've done a deal on, and so it's just crazy how people just sell off. And I think, looking back at the chart, £1.80 before they had any deal on these assets, before they raised cash, and yet it's at 30 pence. And I think this is nuts. I mean, and I said I've never seen. I don't know about you. You've looked at broker notes. I've never seen three separate broker notes with such a high upside here, and this is on
Mm.
the one asset. And this is, we are talking about 850% up, and this is talking about the market penetration of the M3, the first asset, not including XF73, which is double the size. So, and if you go through the broker, like I said, they look at everything: probability, market penetration, pricing, and variances on all these levels. And so they are very detailed broker notes. They're not just chucked out there as a study thing.
Yeah.
Like I said, the three separate notes. But have you ever seen some kind of, and like I said, bear markets present this opportunity, whereas like before, from when they were at 180, then 268 is not that big a target. But we had a big sell off in the market, the bear market. Now at 30 pence, you think this is crazy, So yeah,
it's really I mean, just to get the people's, sort of highlight to people valuation when it comes to sort of like drug discovery businesses, particularly early stage. It's super difficult to get a proper valuation, and they're all done on risk adjusted. So
yeah,
what they're really saying is that they put a chance or probability of something happening, and then if it did happen, what would be the actual NPV upside, and therefore they get their the risk adjusted level. But in reality, what you're saying is that if it does work, then it's going to do even much better. But if it doesn't work, then it's going to zero that asset, that candidate.
Yeah.
So that's the problem. It's just a huge divergence. So you just get these huge, big value events on important clinical trial data. So
like I said, they are going to phase 3 on M3, but XF73 looking at a partnering deal going to phase 3 for that. But external European market research reports that XF73 is seen as very promising alternative to the current standard of treatment by both clinicians and payers. The study suggests XF73 has potential to replace the current standard of treatment as preferred by pre-surgical nasal decolonization agents. So an active partnering thing is happening right now. And Dr. Dura, just have a look at Dr. Dura Barker's background, and then have a look at Neil's background, and you realize that she's such a good fit. So it's worth looking into that. But yet, of course, when a CEO steps down, people just worry, sell, and so hopefully there's a bit of churn in the stock.
Do you still own them at all, or have you basically moved on?
I still own them. Yes, I absolutely still own them, because I just think when you look back, and I really now, when sentiment's really negative across the market, and you realize it will change. We don't know when, but we know it will. We will get back to a bull market. And there's times like this where you look back and realize that was valued quite lowly compared to what it had. And if you go back to even like a year and a half ago, like I said, 180 a share, and they were less developed, they were less cash. And so there are massive opportunities in a bear market, and sometimes you just got to hang on a little bit, and you will see volatility as long as you're not too overexposed. And like I said, there's probably a good strategy in getting some of these companies we've talked about just now, putting very little bit of money into all of them, and just sitting and waiting, because one of them, all you need is one of them to do very well, and you can average up a little bit or invest a bit more in it, and it'll transform your portfolio, because they can be, a world beater. They can be taken out by a big company.
It's one of the reasons why I'm still relatively cautious on the economy, as we've discussed, but actually positive on small and mid caps, because there's so little liquidity out there that it's been exacerbating the selling that's driving share prices down. And therefore, when you look at a price versus value lens, then there's huge upside if you select wisely. So, I'm actually far more optimistic.
It wouldn't take a lot for like some of these companies you've mentioned, like Verici, Lunglife, all that, whatever, to just double quickly because they've oversold. And if you had a little bit of money in there, you just take out half because you double your money and just let it sit and wait, and that's it. There's no risk there for you whatsoever. So and because they're so oversold, some of these is crazy, So
what shares do you currently own then in that sort of like the other 50%?
I still own XPF. I still own. I've mentioned Good Energy before. They've got now literally Good Energy. I mean, they've changed from they had a legacy business where essentially they had solar wind farms, all that stuff, and it was high debt. But they've transitioned to a new CEO. I think he come from a money supermarket as well for that. But they're going to now a services company where they have heat pump installers, but also have feed-in tariffs and all this stuff. But they've got about 24 million in cash, and what are they at the moment? They got like 30 million market cap, and last year they grew profitable. They pay a dividend. I think this is a silly solar situation. They're in a very hot area, like solar panels, heat pumps, also feeding tariffs, and all that stuff. And I think excellent, one of the originals of people believing in renewable energy, and most of their customer base, are into that. And I just like the area they're in. I think it's a very hot area. I did another bigger sort. I've mentioned to you before that I did buy, which have had a few problems, but I've bided my time, as Alphawave. This
Oh,
is
did you
in
buy it?
semi,
Okay,
yeah, not a lot, but because I've been watching them for a long time. And like I said, I waited for their final results to come out. Turns out the CFO messed up all the numbers. He was sacked, and they sacked him. So the share price took a bit of a dip. But one of the directors has been buying all the way down pretty much. And their compound annual growth is phenomenal. I mean, lots through acquisition.
What do
But
they do again?
They do semiconductors, all that kind of architecture, also connectivity to data centers, so
Okay.
low-cost connectivity. So it's very much this AI kind of battle. You really need a lot more data with AI. There's a huge amount of data generated. And so they're doing that. In fact, they've just extended a deal, I think yesterday, with Samsung for their 3MN, sort of semiconductors, tiny little ones.
Yeah, the
So
3
you've got some big
nanometers.
yeah, 3 nanometers. And if you look at the background of the directors there, they've all sort of come from, previous sort of Intel, all these companies, and so I quite like them. The growth is excellent. I'm not quite sure in the valuation. I mean, it's not a huge amount upside if you look at. It's hard to value these companies. You can't compare to American companies. I know Nvidia and all that, so 52 times earnings, whatever. It's nuts. But I mean, even on a basics of a level of peers. I mean, I think 3 brokers have a target price of about just over £2 for this. But I mean. This is over the next year. That is so. But the growth is phenomenal. I'd say it's a growing sector, and I quite like them growth wise. But I don't know. It's hard to know. It's not very reassuring when your company there's a billion market cap, and the CFO gets sacked. You think, why would that happen at that level? And they're growing very quickly. They're acquiring companies very quickly. But it tends to be, but it needs a bit of housekeeping there because it's a little bit worrying. But the sector they're in is just very hot,
Yeah, well, great minds think alike, because I've also sort of just recently bought a customized chip developer, which is called Sondrel. The ticker is SND, which is CEO'd by and was founded by a guy called Graham Curran. It's about sort of like I think it's a sort of market cap around about 30-40 mil, etc.
Oh, is that all right? Okay.
Fairly small. It was. I mean, I've only got a half a position. It's 45 million. I've only got a half a position because I couldn't get liquidity into it. But essentially, they do designs they design, prototype, and deliver sort of like digital or small nanometer chips for customized specific applications, things into accelerated computing, AI, into electric vehicles, into all of these sort of like data centers and stuff like that. But it's the real sharp end. It's the accelerated sort of like computing side of it. So that's the sort of the synergy, and they're onto a huge growth trajectory. I mean, their reported sales from last year would over double what they were the previous year. They're about just over 17 million, and they're going up to around about, I think it's high 20s for this year, and they're up to over 40, etc. And I mean, I've spoken to the CEO, Graham Curran, and their IPR in it, is that they've been doing it for 20 years. They've got all the designs for all the chiplets that you then use and you put together to create these super chips for the likes of, as I say, could be any of the like Apple or people like that who want supercharged, customized, specific chips for them. If you're one of these big sort of like product manufacturers and you want sort of like supercomputing power, etc., then you can either do 2 ways. You can either go and buy an NVIDIA chip or an AMD chip, which will do shed loads of stuff, cost you an absolute fortune, about $20,000, draws huge amounts of power, and be able to do everything, but most of the stuff you don't want it to do. So you're wasting your money. Or you get one which is actually customized specifically for the longevity of that particular product. And this is what these guys do. They typically the manufacturer will come to them, they design a chip for them, which will take sort of like 18 months. They'll then prototype it, which will then tape it up and then get it etched, which is another 12 months. And then they'll basically deliver the actual chipset to them using a manufacturer like TSMC or something like that out in Taiwan, and deliver over the product life cycle. So they've got big visibility over their revenues. He's super confident over the long term, And if the shares come down again, I'll pick some more stock up, etc. But it was just difficult for me to put in a decent sized position. I've probably got about a third or a half of what I want, but it's in the same sort of space. I would class this as a stealth play into generative AI or into all things accelerated computing, because it's a cheap entry in it with expertise, large IPR. As I say, just reinforce what is their USP. It's 20 years of developing chiplets that they then put together, i.e. they own the IPR, to create a solution on a chip for a manufacturer or a major chip. That design then goes to the manufacturer. They own it, they own that IPR, but they don't own every little intricate bit that goes into that particular IPR. That's held by the company, or Sondrel, and then they can lift and shift those chiplets into other designs that come forward. So
yeah, that's pretty much what Alphawave do, but they're a bit bigger. Then it goes to $1 billion. But Alphawave, by the way, I know they've got a hyperscaler. One of their clients is a hyperscaler, which I don't know if you know about those guys, but
I do. Yeah,
it's very.
It's basically Amazon Web Services or Google or Microsoft.
Google, yeah. So they've also got Samsung as a client. And I mean, and if you look at their compound annual growth top line, it's 187%, over the last 5 years. So it's been growing very quickly. The guys in that company, I mean, I quite interested in Sondrel because it's a lot smaller. Are they able? Do they have? Can they get these big sort of, or do they need them? The big sort of customers, the end clients of that.
Yeah, I mean, their contracts tend to be 10 million plus. £10 million plus. Oh yeah. I mean, their design contract can be 5 million easy over 18 months. Their prototyping can be 1, 2, 3 million. And then it all depends on how much the product goes in. Obviously they'll get the revenues coming off when it goes into production. So that can be as big as big as your life, 30, 40 million, etc., depending on how long it is, over 10 years or however, how much the product's in place. But I mean, they're talking to the big guys to be able to do it. Yeah, absolutely. And they have a track record of delivering it.
Yeah. No, I mean, it's just like in that area, isn't it? It's very much worth it getting a toehold in this, because we know one thing, more data is needed, more speed is needed, and also if you can get efficiency of speed and all that, then it's worth looking at these companies. But
the key for investors is why I think this is a smart play. Yeah, is that customized chips, ASIC chips, etc., are a hot area simply because if you can get yourself an NVIDIA chip, you're paying $10,000 to $20,000 for it. It does everything singing and dancing. So there's lots of stuff you don't want it to do, and you're paying for it. And more importantly, it draws an enormous amount of electricity and power. So when you want to put it into EVs, for instance, and it's sucking up so much on the battery's power, then that's absolutely useless. Or using it at the edge computing out in the field where you've only got batteries powering these things because there's no actual cabling, etc. So I mean, it makes perfect sense. It's customized. It does exactly what the actual the end user wants. It's very price competitive, and it's hugely less on the power requirement. And if you want another data point of the ASIC market, etc., customized chip market, just go and read the last quarterly results from Broadcom, because they are just saying they are seeing an enormous amount of demand for customized chips from their people like Apple and people who want their services. So you can guarantee the demand's not a problem here.
Yeah. So what I didn't understand yesterday, right, is that Alphawave Semi, like I said, they announced a deal, extended deal with Samsung. I didn't see it in RNS anywhere. It's like not RNS. So they do silicon IP, chiplets, all that, custom silicon, connectivity products, data centers, and they extended with Samsung, right, with Samsung Foundry. And yet they're doing 212 gigabytes per second Ethernet and all that, and also the chips. And I thought, why wasn't this RNS? I don't understand.
That sounds like it's a supplier, not a customer. If they're using the Samsung's Foundry, they'll be delivering that chip to the end customer. Samsung doesn't sound, they sound as though it's supplier.
So Samsung Foundry platform now, customers now benefit from Alphawave Semi's most advanced high-performance connectivity IP and chiplet technologies, including 112 gigabit and all that stuff. So they supply that to Samsung Foundry.
I know, but I don't know whether they are the Samsung Foundry are making those chips for Alphawave then to deliver to their end customer. I don't know. You'd have to look. Just I haven't seen it, and I you'd have a look at it and just see whether are they is Samsung the customer or is it the supplier? And I
No,
suspect
they're the customer. They are supplying
customer, are
Samsung
they?
their 3nm process node. So they're supplying them
Okay.
with that and their IP chiplet technologies.
Send them an email then, the company. Why they didn't
Why? I know. Why was that just buried on your blog? It's like send it out a bit, because
crazy? Yeah, I know.
Samsung, quite a well-known customer.
Yeah,
And,
yeah, I know.
people have heard of them. So have you? So that's one. So you said you made some more investments, yeah?
Yeah. No, well, I mean, I just got an update on another one. I did actually on Michelmersh, which I said I'd bought last time. Yeah, the premium brick build. I did actually touch base over the last 2 weeks with the CEO, and he was pretty, sort of positive. Frank Han, I was just trying to remember what his name is. He's leaving actually in about 12 months to go to Brickability. The shares are just hugely undervalued. Basically their P&L is pretty much, I mean, there's no doubt about it. It's more challenged, the housing market and the brick market, than it was 12 months ago, because what happened after the trust economics, they slowed down new build houses, and it meant that lots of the distributors and the housing building boys effectively ran down their inventories and didn't order. So that was a big draw. But actually, the inventory levels across the industry are still pretty much low, and very low where where they're actually operating at the premium end for more aesthetically looking, products, etc. And now the house builders are breaking new ground and starting. So, I'm pretty much optimistic. He just reinforced to me that this is a rock solid business, good long-term fundamentals in niche markets with good pricing power, great relationships. And the one issue that I had was basically, in terms of energy hedging contracts, what would that mean? And essentially what I think is going to happen, reading between the lines, is that they're just going to, if they don't sell any, if volumes did sort of turn down at the second half, which I don't think they will, because we're putting, basically new houses up start breaking new ground. But if they did surprisingly turn down, then they're just basically build to inventory, because they need it. I mean, they are desperately short of inventory, because their stock days are super short, super small compared to what they should be, for proper service levels. In fact, they are across the industry. So, yeah, I mean, the whole industry has been sold off. It's baby in the bathwater stuff. And I'm absolutely delighted that I picked up a full position in that one. So yeah, that was the last bit of in the jigsaw. The one thing I would say, just returning to Sondrel and to Alphawave, that people, if they want to get into that space, need to be aware. The biggest risk is effectively that it's lumpy contracts. Basically, if you do cost to complete on your contract, and essentially some revenues fall in the wrong side, then you're basically of a period, etc. Then it'll hit your numbers. That's the only sort of downside, is that there is some lump. No, so but with Michelmersh, you don't get that. It's continuous, and I could see them doing. I mean, I could easily see this 150 rather than 90p. Easy, and it pays a good dividend. It's got a great balance sheet. So I was pretty much impressed.
Yeah, it'd be interesting to see. Some news from house builders of late to see what's happening.
The trading statements are good. They're all good.
Yeah.
You had Cressy Nicholson's, you've had Persimmons, Taylor Wimpey. They're all saying the same. The one thing that is knocking them a bit is that cladding issue, but that's a benefit for for the likes of Michelmersh, because they do brick systems to be able to replace the cladding. If anything, it'll be supportive to them.
No, I definitely want to take, but I mean, I don't. Again, Gleason dropped out, and I sort of just sold. But I definitely want to get back into a house builder. For when we see some clarity. Because I think at the moment we are literally, if house prices go up, bonds are going up, like I said, and interest rates are going up. I just want to see how that will knock the market a bit, because I know from personal experience the market is very slow at the moment. And I've been speaking with lots of estate agents. It's slow, it's hard work. So I just want to see how that works. It's like getting mortgages. It's just gone up, and it's a bit scary, really.
It's tough. I'm certainly not saying that we're seeing a huge buoyant housing market. I don't, but I actually think something like Michelmersh, being a niche, product supplier, they'll either get bought out by somebody, or by the time basically the slowdown finishes, they'll be in a much even stronger position, competitively wise, to really, to do well when the upturn does occur. So yeah, I think it's a good place to be perfectly honest. I mean, another one which is which on the sort of like the OTC or healthcare products company, which had a capital markets day, was Venture Life last week. And what they did was lifted the lid on their long-term, sort of like forecast, what they're hoping to do. I mean, they don't, you can't criticize them for not lacking ambition, because they are looking at 100 million sort of like revenue line over the next 5 years, which is about double from where they currently are for this year, which is about 50. And they're significantly undervalued at the moment. I mean, I think Housebroker's got a target price, Singer's have got one of about 84p, and I think they're trading at about 40, so half of that. But if you look at doubling doubling the revenue over the next 5 years and driving higher margins, because more of the revenue will come from their own products rather than third-party distributors, then that's going to totally, if they can pull that off, it's just going to drive that share price higher and higher and higher. So yeah, I mean, I would, if people are interested in buying shares, I would strongly recommend they get hold of the presentation from the Capital Markets Day, because it's a real eye opener, and it gives you about 120 odd, 130 odd slides actually about the business, about the relevant divisions, the product usage, their distribution strategy, the marketing, etc. And yeah, I mean, they've got a good front bench team there, and very good growth drivers. So I mean, in this market to double your business on a high margin, I mean, this is like 20% plus type, potentially EBITDA margins, easy, even 25.
Yeah. So I went on a rabbit hole then, looking. You went back to semiconductoring. I had to go back to, I'm just saying they in the last training statement, the CFO stepping down, the mess up in the numbers. Really,
you're talking Alphawave again.
Yeah, Alphawave really detracted from some of the achievements they had. They just achieved their first quarter of 100 million in bookings, right? Yeah. First 3-nanometer design win with a top American hyperscaler. And now they've got Samsung. And I just went down to looking at semiconductor manufacturing processes and the size of them and how fast they're coming out. And literally, they've gone from, in 1987, 800 nanometers was standard, and 800. And every year they're just coming down. And now that 3. Yeah, and the future, they say that's the future right now is 3. But next is 2 in 2024. But it's phenomenal, the pace of growth of technology, and technology enables technology. But yeah, so hopefully, and also just worth looking at the chart of Alphawave, just sort of broken out of a previous high after going down for a long time. So I think maybe it may be starting a little uptrend. But yeah, I think that area is very good area. But you said you've got to be a bit selective. But we're only going to need faster, better chips to process more data. Like I said. In more efficient ways in the future, aren't we? I mean, AI gobbles up so much data. It's phenomenal.
Power as well, importantly.
Power.
Which makes a lot of it for the customized chips. Another one I've bought on the medical devices area is Inspiration Healthcare. That's ticker IHC. And I've spoken. I've spoken to their CEO Neil Campbell just recently, and he's sort of reiterated my thoughts. It's a rock solid business. It's got 2 elements. About 2/3 of the revenue comes from its own sort of like neonatal baby ICU ventilator heating sort of products and stuff. So when a baby is born premature, and it's obviously it needs some help, etc., whether it's the right temperature or the right breathing, etc., it uses it can use the Inspiration Healthcare's sort of like devices, etc., that help them to recover and to get through. And they sell all these devices in the UK, Europe, and out in Asia. And they're trying to get actually approval for their standard ventilator out in the US as well. So that should happen over the next sort of like 18 months. But the shares have been sold off last year, largely on the back of because of the China lockdowns, which was quite a big market, and Russia, which was again another hit to them, etc. They still grew top line, but they missed their targets, and therefore, because of what we've talked about, illiquidity, etc., then the shares have been knocked down. So the main part of the business is their own IPR. It's all of that sort of like best in class baby ICU units, prenatal, sort of like incubators, etc. And then the other side of it is infusion devices that they sell into the UK. They've got a license from a Greek company who do these sort of pumps that help patients maybe feed themselves or take drugs intravenously when they've got finished on cancer, etc. And that's done well also. Anyway, to cut a long story short, they're through their troubles. They also had supply chain issues, chip shortages, surprise, last year. They're largely through that. They're still struggling actually on their supply chain to get, consistent supply. And so they're having to hold stock, which they did. That drew down some of their, sort of cash at year end. But all those headwinds are now easing on a like-for-like basing effect for next year, and they expect to sort of grow. I think it's roughly around about 45 mil turnover for this year, and then really sort of start accelerating for next year. And just on the sort of the valuation wise, I mean, I would say this is easily a sort of like 10 times EBIT type businesses looking at over the next 12 months, 18 months, and I get a target price of 80p compared to the share price of 46. So I've struggled buying liquidity. I've bought probably a 2/3 position. If it stays where it is, I'll pick up some more shares. I need another half or so in Sondrel, as I talked about. But I think it's a really good company. And Neil's been around, for ages in terms of he knows the ins and outs of that business. And, I'm very much optimistic. They've got a bit of debt at the year end, but that should, with the cash generation, that should become a net positive cash position by year end, which will then give them the balance sheet strength to then consider, sort of M&A, etc. But again, if it stays these levels, I would not be surprised if somebody puts a number on them and buys them out. But and then
do you ever worry about liquidity? Sorry, because I've been more aware of that now. I mean, just looking at Inspiration Healthcare, like average daily volume is pretty much 27 grand. In total traded. Do you worry about that? So sorry, it's more than that, 170. So it's double that, double that.
Do I worry about it? If it makes it annoying, to perfectly honest, I don't worry. As in, like, if I want to chuck in quite, a decent position, then it just takes me ages to get in. And obviously, if I ever wanted to sell it, it would take me ages to get out. But I do. As I've always said, I'm a long-term investor, 2, 3, 4, 5 years. So short-term volatility, as long as the investment thesis is fine, it doesn't really worry me much at all. But it is annoying. Let's be clear about it. In terms of, I can't get in when I wanted to get in, and you can't get out when you want to. So it just takes a lot longer. It's a bit more sort of like time and patience. But no, it doesn't worry me because I trade through that noise. But
for example, I mean, if something goes wrong with an individual company and you've got a big chunk in the, a company that's small and you can't get out, is that? I mean, did you?
I can. I do. I dump the shares. I mean, I did it with. Let's be clear. I had to do it with Rosslyn, didn't I? I did it about 4 or 5 months ago. I mean, you sell at a ridiculously low level. I mean, you just got to accept that if you're going to go into these things, they're difficult to get in and they're difficult to get out. If you want the sort of the long-term upside story, it's just part of the risk. And if you have to sell and drive the shares down, you have to sell and you drive the shares down. But I've got no intention on. If anything, I'm going to add to my Inspiration Health. I'm going to add to my Sondrel shares on it. But lots of things are really illiquid. I mean, I'll come on to the third one I've bought in a moment, and even that's a much bigger company. I've struggled getting shares on that one as well. So
but when you're chucking 10 million quid in, when you're trying to build 10 million quid, slots there, it's hard work for the money bags, Paul Hill. Oh, Paul's on board. Here we go.
Anyway, I mean, the third and final one I've bought this over the last 2 weeks is TP ICAP. Which is basically the world's biggest interdealer broker. I mean, it effectively does liquidity. It does, executes trades for institutions in things like interest rates, into swaps, foreign exchange, commodities, energy, and they'd also do sort of like really, really big pieces in their liquidnet acquisition, which they did about 2 or 3 years ago. Anyway, the shares are ridiculously valued. They're about 6.5 times PE. They pay about 8% or 7-8% dividend yield. They've got cash on the balance sheet. I mean, it does need capital for its on a regulatory purposes for that sort of stuff. So if you that's their sort of bread and butter stuff. The whole sector is isn't valued highly at all, and that's because people have this view that actually voice broking is going to zero, and it isn't, because these are highly sort of customized trades that people want to do, whether it's in sort of forwards or in currencies or in commodities and this sort of stuff. So they're very specific to the customer. So voice broking will always there, but it has put a bit of a drag on that growth. But anyway, that the base business will grow, but the real sort of crown jewel is their Parameter data business, which has really attracted me. And again, this is another stealth AI play in my view, because what it does through the trading mechanism of the base business, it collects all of that data and then sells the data to lots and lots of different financial institutions, and people like Bloomberg and Reuters and people like that, and Retinif and people like that, who then use it because they can actually then see pricing and volume data for non-over-the-counter, non-listed products and stuff, and do charts or whatever they need to do. So this is really valuable data. It's almost it's 95, 8 or 98% recurring revenue streams. I mean, it's enormous. It's growing. It's sort of like, high single digits, double digits per annum. It's got 50% sort of like, contribution margins, 40% EBIT margins. And on that basis, given that this is a sort of like, it's unique data that they own, you put sort of like really neat sort of AI algos on top, and you can then really sort of drive that top line, because nobody else can capture that data. They've got unique proprietary data there. So how much was that worth? Well, it did about 80 million of EBIT last year. You stick a sort of like a 15 times multiple for a very, very high recurring revenue, highly profitable business on it. 15 times EBIT is not exactly that expensive. You get 1.2 billion. The market cap for TCAP is currently 1.2 billion. I mean,
billion,
so it underpins it straight away. And then how much is the rest of the business? Well, you get stuff, even if you only put sort of like a 5 or 6 or 7 or something like that, EBIT multiple on the existing business, you get another 800, 900, million on top. And when you look at it through that lens, I get to market cap or fair value target price around about £2.50. compared to the current shares and about £1.60. And on a sum of the parts, I think HSBC have got a target price of 290. They've got an actual overall target price of roughly around about 220. And I think Peel Hunt have got about 240 price target. So the significant upside. The difficulty is if they wanted to, is to separate Parameter without actually having any tax leakage out of it, not incurring a big, sort of tax bill. And I think they're working through that, but they do realize they're significantly undervalued, and they look to sort of like, release some of that hidden worth within the actual group. And it was highlighted to me by Christopher Mills and Gervais Williams, and I've bought some shares. I've got a full position now, but even as I say, I even struggle to get, some liquidity, even in a share which is worth 1.2 billion. It wasn't amazingly liquid.
Yeah, no, it's odd because I when I fill out the spreadsheets and stuff like that, I do put that in. So average daily volume and then divide by 10, seeing how easy you can get in and out. So if you look at that, it's 140 grand, I suppose. That's 1.4 billion is the thing. But do you know what? I saw Christopher Mills and Gervais Williams actually worth watching. If you haven't seen Paul interview these guys, and in fact, Christopher Mills highlighted on the market, and that's very interesting actually how that's come down. And it's one of those things where it's not a relationship with the valuation, what they're doing. They've got this drip sell of agents that are allowed to sell now. And that's the problem with the stock. It's very liquid and it's taking it down. Now, I don't know when this dripping will stop, but I think then it'll start to rebound very quickly after that, because the fundamentals of the business are quite good and the valuation is very good. And like I say, it's a portal where, so they don't have to own lots of stock or sell lots of stock. Literally, just trades getting done, deals getting done. And so the technology offer is very good as well. So I don't own hold, but I've been watching them on the chart thinking, when will the sell-off stop here? Because it's getting to silly levels. It's getting to almost silly levels. In fact, it bounced yesterday, and you'll see that.
What isn't at silly levels at the moment?
Yeah.
It's like crazy, isn't it?
Yeah, exactly.
So I was just top level. I'll put it on. I'll post it sometime over the weekend or the next week or stuff. I've now only got just over 20% of my portfolio held in cash. So most of it's in stocks, and I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 stocks. Wow, increasing. So hopefully I'll get another 2 or 3 over the next few months. But I'm very happy with what basically with the new purchases, Inspiration Healthcare and Sondrel and ICAP.
Yeah, I'll have a look at Sondrel actually, because I think Yeah, I mean, I didn't realize there were semiconductor companies that small around. So it's very interesting if they,
Yeah.
if they can
Oh,
improve.
I mean, the thing is with, as I say, the Sondrel, it's basically its key focus is in that, the digital sort of like accelerated computing power, the chips. So it's customized accelerated compute. It's that down to that 3 nanometer, which is where the industry wants to get to. It's not on your mixed signal type of digital and analog. It's in the real sort of like the hyper growth stuff.
Yeah.
But it is lumpy contracts, so it's not without risk.
Marvelous stuff. Okay, well, I guess I'm going to start buying some stuff. I think I've got a bit of cash. I haven't got many stocks. I mean, do you know what? The only thing I'm actually regularly paying into, because I think rather than sit in cash, is like an high dividend yielding fund, which is a BlackRock fund. IUKD is the ticker. It's basically a FTSE 350 high yielding stocks. I mean, I'm just so bored at the moment. I'm waiting for things to happen. I mean, so yeah.
If you want a high dividend paying stock, buy a TPI cap. It'll pay you 7 or 8%.
Maybe I'll do that. Yeah, I mean, there's plenty around, but it's like, do you know what? I do find smaller stocks and microcaps more exciting than bigger stocks. That's it. And I thought, should I look at both, or should I just have a fund for one and then just go for it? Spend more time looking at microcap stocks. So I do find them more exciting. They are more exciting. Full stop.
Not if you own Nvidia.
No, I know. Yeah, exactly. Well, saying that, it's just got a bit nuts, isn't it? I mean, there's a guy.
I could handle it. I could handle it though.
I can handle it, but it's like, are we in bubble territory there? And that's why I don't know. I'm being cautious. I don't know what I'm waiting for. I'm waiting for something. And certain stocks I'm looking at, but I just want them to come back a bit, because I'm thinking they've rallied a little bit and they've come off the bottom, but they may need to sell off. And they are largely small micro cap with IP. Validation by bigger companies, all that stuff. But
the key thing to me is, what's your time horizon? Okay, and if you're concerned it's this year, then I can understand your hesitancy. But if you're looking through this year or next year and you're happy to hold for 3 to 5 years, as long as the investment thesis is fine, then you're going to do well, in my view, very well. But it can be rocky for the next 6 to 12 months. Who knows if the economy goes up and sentiment goes up and down, then it's unlikely we're going to see improved liquidity. Higher cost of capital for small caps it's going to be a continued headwind. But once that breaks, then the valuations will correct very quickly.
Fingers crossed. Marvelous stuff. Cheers. That's a long one. Speaking in 2 weeks' time.
Bye.